In this week's update, significant reversals driven by dynamics, not fundamentals. This is opportunity time, and the oil price and the duration of the disruption will determine how this plays out. My name's Gary Davis. I'm an authorised representative of Primary Securities, and as always, the information in this video is of a general nature only. Wartime markets have a bit of a signature, certainly in the early stages in the first few weeks. So this does not appear to be a systemic alarm situation. There's too many things that are still trotting along quite positively. And really, when you compare back to previous onsets of war, this is pretty normal behaviour for the market that we're seeing. There's really nothing different. We're seeing equities down. We're seeing gold and silver down because they're liquid and they can be sold under forced selling. We're seeing the US dollar up. We're seeing energy up. These are all things that are pretty normal for the onset of a war situation. But if the supply of oil drags on far longer than what is currently the expectation, and oil gets up into the 120s, 130s, then we've probably got a fairly different ballgame on our hands. But we're not there yet. No point in guessing, no point in trying to forecast. It's worse than not even thinking about it because it plants the wrong seeds in your mind and you react accordingly. So what we're seeing is continued repricing that's been going on for 6 months, particularly in the software space due to the fears about AI, and also just some rotation, which again is normal. Rotations happen under all market situations, whether there's wartime conditions or not. So this is not broadly based desertion of the market. Money is not flooding away from the market. It is just rotating. And that's a completely different scenario to if markets were selling off heavily and institutions were reducing their exposure and cashing up. That's not where we are. We're seeing short-term volatility, that's natural, around headlines, and a lot of that is being driven by forced selling because of leverage, because of the demands of margin calls that have to be met quickly. That's really all that's going on here. Now, the short-term volatility is hard to take, and that's why I've been preaching for 1,000 years the importance of clarity of purpose, clarity of process, and clarity around the time frame that you're playing in. What a short-term trader does to what a long-term investor does are light years apart. And if you haven't even thought about what your time frame is or what your purpose is with each transaction, then frankly you shouldn't be in this kind of market because you're going to get sliced and diced. It's going to be nasty. So this is far from a natural market, so don't try and read too much into it. And we have got a question that I will address because it's important. I think it's important for everybody from a perspective point of view. And the one thing that I've always sought to do in the 17 years that I've been running this Sunday video is to provide a perspective, just an objective, unemotional perspective that would be beneficial for investors and probably something that you don't necessarily hear from most of the mainstream media. Now, in America, the growth and the earnings are still supportive of certain parts of the market, but it's becoming increasingly important how selective we have to be. It's a very diverse market. If we look at the Australian market, highly sensitive to commodity moves, and we saw quite a nasty week for the materials sector last week. It's also a market that's a bit hostage to China demand, and some of the signals coming out of China are not for the sort of robust growth that we're accustomed to coming out of China. Our market is also hostage to likely rate rises, which is going against what's happening in most other places around the world. And of course, we're hostage to geopolitics as well. So our market is just going to get tossed around like a cork in a bottle frankly. And again, this is a period where you don't want to read too much into the very short term because it could be completely different tomorrow. Now, resources had a great period. And one of the things that I said last week was that having a commodity heavy portfolio was one of the best bets that you could make. And that is still absolutely the case. But it had a great run. We saw some profit taking on some weakness in resources. It's just normal. In fact, it's healthy. You're actually better off. I know it's a bit painful during the week while you're experiencing it, but it's actually healthy. If you're a long-term investor and you're looking to make significant profits from the resources sector, then everything is still on track. Everything is still in place. You're just going through a bit of a bumpy period, and that's how you need to see it. If you've got some cash, then you want to cheer on a quick and deeper correction because that'll just set up prices on stocks where nothing has changed. And they're already, particularly in the precious metals and copper space, they're already cheap. And they're probably going to get cheaper if we get some more commodities weakness. And at the moment, the very short term is that commodities are under pressure. But what you need to be on alert for is where we've got megatrend stocks. So however you define them, the 6 or 7 megatrends, if you've got the highest quality stocks within those sectors that have been going through a correction, and particularly one which stands out as being quite obvious is technology software stocks have been getting an absolute thrashing because of fears about how AI may disrupt their business. But in some cases, the impact is going to be probably negligible and could even be positive. And yet they're being sold off like their business model's destroyed. It's completely irrational. So you want to be watching those sort of stocks. But first of all, you need to know that they are the best of the best and that their business model is going to stand up robustly against AI. Once you've got that, then this sort of deep correction that we've had is an absolute godsend. And we're seeing that a bit in the Australian market with the infotech sector reversing in the last couple of days, reversing quite strongly. So when you're coming out of a very deep decline, you've just got to be a little bit careful that you don't stumble into the top of a W pattern and you buy and then the market goes back down again because it hasn't really finished bottoming. So that's why I say probably. But certainly the signs are looking good. And the signs in America are very clear as well with the software sector. And we'll have a look at some charts on that in a minute. So be on alert for what has been out of favour and is now confirming a reversal. It's just the lowest risk way to operate because when you're buying after a smashing, as long as the fundamentals are still really supportive of much higher prices, then your downside is minimised by definition and your upside is maximised also by definition. So it's just a great way to play it, but you have to have done your homework. You can't just buy anything. And in the Australian market last week, the energy sector was the only sector to hold ground. It went sideways, so nothing terribly spectacular despite what happened to oil. But the other sectors went down. Really important in this kind of market, you don't want to wander in with a blindfold on. You need to have all your advice lined up before you start investing. Let's look at American stocks now. The S&P was down 2% for the week, and the Nasdaq actually did better, was down 1.25%. SMH, which I follow like a hawk, semiconductor ETF, finished negatively, and we've now had a series of negative daily finishes. Nothing dramatic, but it is changing character. Or I think all you can say at the moment is it's changing character to sideways. It needs to break support to take the next step. But we'll look at that in the charts. Now, the Russell dropped 4%, small caps being hit a little harder than they were in the previous week. But the squeeze, the short selling squeeze is on in software. And there's several ETFs that cover that sector, but IGV is a good one and we'll look at that. But it's certainly moving higher, like the short sellers are getting squeezed out. The US dollar index was sharply higher, but off its highs, just under 99 for the week. The 10-year yield shot up from below 4, got up to about 4.2 at one stage. And the VIX finished the week in fairly stretched territory at just a tick under 30. So that's not particularly great news from that point of view. All right, let's start with the S&P. And I'll start first of all with the question that I got. From a technical perspective, it appears the S&P is starting to break pretty key support levels. Well, it hasn't yet. There's the key support level, and it hasn't broken it yet, so it's not starting to break. With lower highs and lower lows, okay, I agree with that. There are lower highs and there are lower lows. What would be a good level from your perspective to look out for to potentially catch up from the index perspective? 6,700 is a key support. Would you agree? Yes, I do. That is a pretty obvious level. But I think about the indices, and I've been saying this for years and years and years, that I don't place very much stock in what the indexes do. So that shouldn't come as a surprise to regular viewers. And using an index only as your measure of what the market is doing doesn't provide nearly enough information at the best of times. Because using an index as your measure kind of implies that everything's trading the same as the index. And when we get to the sectors, it just couldn't be further from the truth. So that's the first point. The second point is we've got a massively bifurcated market with stocks going powerfully higher and stocks going powerfully lower. And then on top of that, we've got some short-term reversals like software, for instance, in the last week or so. So looking at the index, it just doesn't give you any worthwhile information at all. And what you own will almost certainly behave quite differently to the index. So the other point is, it's not just whether the index breaks or not, it's how the index support breaks, if it indeed does. And at the moment, what we're seeing is candles that are not really giving clear signals. This dropped and then it closed way off its lows. This is small range, hardly definitive. This isn't a whole lot better. This is only small range. So all this messy chopping backwards and forwards, that doesn't say anything definitive about the market. If I'm going to use a support break, then I want to see something like this, the 20th of November, and then I want to see follow through, not an immediate reversal the next day, followed by 5 more sessions. We need this, plus we need follow through. So long range, closing on its lows, that is far more definitive than this wimpy little attempt to break support. The only meaningful way to deal with the market, in my opinion, this is my way of doing things, is forget the indices for a start as your primary tool. You need clear exit signals and you apply them to the stocks you own. You'll have some stocks going up, some stocks going sideways, some stocks going down. Hopefully that is the more minor portion of your portfolio. Then you just treat each one on its merits. Who cares what the index does? It's just not relevant. So I can tell you that the media preoccupation, you turn on the television at night to find out what happened in the market, and all you get is the index did this. Well, who cares? So what? It's just not relevant. So if you join the media in this preoccupation with what the indices are doing, you will be poorer for it. So my advice is, yes, observe. And if we got a session like this and followed up by another session that looks something like that, then that's meaningful. But I would also say that the stocks that you own are probably also doing this as well. So why not just watch them? It's about as strongly worded as I can put it. And just to give some examples, this is XLK. So this is the whole general technology area, which has got obviously quite a lot of diversity within it. And as a result, we've just got this kind of, tepid sideways movement. But if the bulk of your portfolio was in XLK stocks, then what the S&P does may have a bit of relevance. But what if you're in this? What if you're in IGV? What if you've gone long on this reversal signal? This is a pretty potent reversal signal. My goodness, look at the volumes. Day after day, only one day down. And the other thing that always bothers me is, what if you were so preoccupied with what the S&P was doing or what the NASDAQ was doing that you just kind of forget about the rest and you actually didn't see this? You didn't see IGV reversing in this fashion, or you didn't see the Australian tech stocks reversing in the last 24, 48 hours because you're preoccupied with the index. And that's where I think this focus on the index is so fraught with danger. So, what if you've just gone long that? What if you've been long XLE? This is a weekly chart. We've now got 6, 7 weekly higher closes. Who cares what the S&P does if this is what the energy sector's doing? What about gold, GDX? Bit of a nasty week last week, but it's still tracking above the 8-week moving average. Same with silver. So you just want to be very, very careful about what you're using. All right, this is the NASDAQ composite. Now, yes, we're in a big sideways band. Yes, we're in very short-term downtrend. But again, it's very tepid. There's nothing definite about this. There's no convicted selling here. Now, if this breaks, it may or may not be meaningful for the stocks that I own, but I'll deal with that by just looking at the stocks that I own and asking whether one of the 3 exit rules has been breached. It's pretty clear. I don't do anything else. Now, let's look at some of the spreads. This is consumer discretionary versus consumer staples. Consumer discretionary regained a little bit of ground, but it's probably more just of a pause at the moment. This is important. SMH. SMH starting to change character, perhaps. We're now down very close to key support. So that's one that should be watched, because that would be a change of character if we start breaking these support levels, because we haven't done it for a very long period of time. Let's look on a sector basis. What happened last week? XLE, energy, went up to sideways over the last few weeks. Materials got smashed. Industrials got smashed. Staples went sideways. And everything else is tracking down very sharply, with XLK at the bottom, technology and finance at the bottom. As for the Australian market, materials had been leading and leading clearly, really outstripping energy. Energy went sideways. Materials got murdered. Banks sold off a bit. There's the ASX 200, which is just really a balance of all of these. Communication services was up a little bit. Healthcare did nothing. And here's information technology at the bottom. But this is starting to look more like a reversal, and this is far more positive than any of these. So these are the things that you need to be looking. Currencies. It's on a weekly chart. This is DXY. You can see we did actually break through this down-sloping line if we put this on a daily. So if we did have a little intraday break, and then we just kind of held that. Now, again, this is typical wartime behaviour. Bit of a move into the US dollar as a perceived safe haven. It's not really, but it still gets treated that way. So that was the US dollar. The Australian dollar was strong, as you would expect, until we got that bit of commodity weakness. This is also on a weekly chart, but we managed to close just a tick under 70. Turning to Aussie Stocks, 69.55 is where we finished. We trended higher, we broke out, and now where do we go from here? I have no idea. Don't even want to think about it. There's too many moving parts, too unpredictable. I'm just getting on and doing what I'm doing. The ASX 200 index was down nearly 4% for the week. I don't know whether we'll get any respite on Monday. Last Monday, the market response was absolutely fine. It was so surprisingly good given what had happened over the weekend with America and Israel moving on Iran. Monday was surprisingly calm. But then we got the normal behaviour and it set in very hard. So equities were down because that's what they do at the start of a war. Gold was down because it's available for sale to meet margin calls in other areas, and a whole bunch of other forced selling reasons. The US dollar was up, oil was up, and other commodities were down. So it's all normal stuff. Nothing different. Materials lost 8.5%. The banks were down a little bit. Energy was up 7.4%, and information technology was up. So that's the Aussie market last week. Turning to precious metals, gold lost 2.3% for the week, 51.59, and 73.40 in Australian dollars. So we're still right up near the peak there. Silver was down 10% to 84.33, but there was a 19% range, as we'll see. Very big range, so really volatile. The big picture, I'm absolutely convinced that we are still in the early, very early stages of a bull market in gold, and therefore silver will follow. And history shows that they normally run for the best part of 10 years or more. And we're only really maybe 2 years in at the most. So there's a long, long way to go, but it will not be a straight line. It will not be an easy journey. So if you're thinking of just sitting back and enjoying the ride, then you better have ice water in your veins because it's going to be a heck of a ride. But I think it's going to be one of the best investing rides you might ever see in your lifetime. So it certainly pays to get it right. Be very clear on what is a good mix for you. Now, what I mean by that is, what do you want to own in terms of producers, advanced developers, or perhaps ETFs? If you're someone that doesn't want to own too many different stocks, then you can always do that with an ETF. Now, you're giving up performance. An ETF will get slaughtered by comparison to the best achievers. But as long as you're prepared to give up performance, it does give you a broader diversification and it is simpler. But you need to be clear about what your mix is. Otherwise, you're grabbing for bubbles in the air whenever you hear something or read something. Now, gold stocks, GDX, listed on the ASX, was down 8.2%. We'll probably see a bit more of that on Monday. GDXJ, listed in America, was down 13%. And SILJ was down 15.5%. So an incredibly volatile week. Let's try and make a bit of sense out of that. We'll start with silver. This is on a daily chart, so you can see massive range on Monday and Tuesday. Monday gapped up, traded high, and then after that, there was a lot of selling pressure. But if you look at where we're at and where the likely support is, we might see 55. So we could get down to here, but I'm kind of doubtful on it. But I would put 55 as the low. I think this is probably a bit more realistic. So say 65. So 55 is a possibility, but unlikely. 65 or 73. There are a couple of other areas. But in 12 months' time, the overwhelming probabilities are that this will be much higher, and I expect that we'll trade above 120 and perhaps a lot more than that I'm not going to buy into that kind of prediction game because it's just silly. This is gold on a weekly chart. So you can see not a lot of damage done, and this is still a very, very strong trend. So the lows in gold, I would think maybe 45.50 might be the low point. I think if you've got an opportunity around 45.50, it's really hard given all the dynamics. Hard to see it going much below that. And on a daily chart, it doesn't look terrifying at all. And that's why the sell-off in gold stocks has been so irrational. They were already undervalued. And the Australian gold producers that have reported in the last week or two have just been showing what free cash flow machines they are. There has to be some enormous catch-up at some stage. And that's the gold price in Aussie dollars, also not looking terribly nasty at all. All right, other commodities, copper was down to 5.76. Absolutely nothing has changed in the copper market. The only thing that has happened is the price has gone down. But the long-term fundamentals and valuations remain as they were. And the world will run out of copper in terms of supply and demand. And look, if someone panics into selling their copper stocks for a ridiculous price, then what am I supposed to do? Am I supposed to say, no, you shouldn't sell? I'm going to take it up because there's a lot of people out there that are just panic selling. They're just giving in to their emotions and reacting to the pressure of the situation. So be prepared to snap up what others don't want. Crude oil hit 91. Huge surge last week, as we'll see, and what a difference a week makes. We'll come back to that. That's the spot copper chart, so not a lot of change for the week. But there's the crude oil chart, massive rise from 65 up to above 90. So a huge week for crude oil. And interestingly, oil stocks didn't do nearly as well. So there's a bit of a lag going on there with oil stocks. Wrapping it up, the final message, the price action that's happening at the moment is transient. There's forced selling. There's a whole lot of non-normal dynamics in play here. They never last all that long. So don't let this kind of transient price period throw you off. If you've got a clear and solid view of what you want to do in the market, then don't be thrown off by what's happening. For long-term investors, nothing has changed, except now we're getting some better short-term price entries. What you do with them is up to your plan. We're seeing some rotations. We're seeing some wild volatility. And that can be daunting if you allow it, but you don't have to. And one of the ways that you could combat that is just to be so very clear on what your purpose and your process is. So just pay attention to the basics. There's nothing tricky or clever about really good, effective investing. It's just paying attention to the basics, not getting put offline by the market or by the media, and just keep doing what has worked in the past. So that's it for this week. I'm sure we'll have another week of stunning activity, and I'll be back with you next Sunday. Cheers.